Hey guys, welcome back to another episode. In this tutorial, I'm going to uncover the 13 best price action strategy for day trading in the financial market. This video is a product of my personal research on the easiest and most reliable strategies for beginners. This is a trading journal that I made for myself and also decided to share it here as a way of documenting what I've learned so far to help as many people as possible who may have need of this information but does not know how to get them. This is a well-detailed guide that anyone can learn even if you haven't placed a single trade before. You can use a timestamp to jump to the strategy that interests you most, or you can write from the very first to the end without skipping any part so that you don't miss out on any vital information. And before we begin, I would like to point out that the information provided on this channel is for educational purpose only. Forex trading involves high level of risks and can result in the loss of all your capital. Therefore, consult with a qualified financial advisor before engaging in Forex trading or any form of financial investment. Without further ado, let's begin. Price action is a study of price movement in the market, the patterns and behavior of price. Price action is purely technical and does not involve the use of indicators. It's the use of candlestick to predict the market. It is very important to understand price action because understanding of price action gives a trader insight to what the market will likely do and help one make a better informed trading decisions. Price action strategies present you with better entry opportunities with less risks and high profit potential. Now, the first strategy we'll start with is the M15 timeframe strategy. The M15 timeframe strategy is one of the most reliable scalping strategy in the Forex industry. It's easy to trade and does not require much analysis. To trade this strategy, you will place a vertical line on the open and close of each market session. There are 4 major market sessions in the Forex market. We have the Sydney session, the Tokyo session, the London session, and the New York session. On your trading view, set your time zone to UTC. The Sydney session opens at 10 p.m. and closes at 7 a.m. The Tokyo session opens at 12 a.m. and closes at 9 a.m. The London session opens at 8 a.m. and closes at 5 p.m. while the New York session opens at 1 p.m. and closes at 11 p.m. Overlaps are when two sessions are trading at the same time, and we often have the highest volume during this period. For example, between 8 a.m. and 9 a.m. when the Tokyo session is about to close and the London session is about to open, and also between 1 p.m. and 5 p.m. when both London session and New York sessions are open. These periods are always characterized with high moves in the market. Of the 4 sessions, the Sydney session is the least volatile, and most traders don't trade it because of its range, while the New York session is the most volatile, and so you have to be very careful when trading this session. In this strategy, we will ignore the Sydney session and focus more on the Tokyo, London, and New York session. To trade this strategy, like I said, set your time zone to UTC or do conversion from your local time. Now, place a vertical line on the London Open, which is 8 a.m., then on New York Open, which is 1 p.m. or 13 o'clock. Then place another vertical line on the close of the London, which is 17 o'clock, and also on the close of the New York, which is 22 o'clock. Place a vertical line also on the open of Tokyo session and also on the close, which is 2 a.m. and 7 a.m. respectively. After that is done, draw a horizontal line on the highs and the lows of each session and drag into the future. The line should be thin and shadow-like to avoid overcrowding the chart. Every good strategy has a set of rules that must be followed in order for you to see results. In this strategy, these are the rules that must be followed. 1. It must be done on the M15 time frame. 2. The vertical lines should be placed on the open and close of each market session. 3. This strategy works best in a ranging market. 4. Mark out your previous highs and lows for entry opportunities. From the marked out highs and lows, trades can be taken from them with ease. Here in this low, price tapped in and moved up immediately. Here in this high, price gave a shooting star candlestick before dropping. Here in this low, price rejected it and moved up. And also in this high, price failed to break from this previous session high and dropped with a very long candlestick. Also here again, price tapped in this line and gave a shooting star candlestick to the upside and dropped. This happens because the previous session's high and lows has to be tested before every major move. So you will just wait right for it to get your entry and ride along with the trend. The entry confirmations to look out for are rejection wicks like the shooting star candlestick or a bullish engulfing candlestick on the horizontal line. Once you have your entry, you place your stop loss just below or above the entry candlestick. Another example here from Euro Odd. First, we place our vertical lines on the opening and closing of each market session. 12 a.m., 8 a.m., 1 p.m., 5 p.m., and 10 p.m. respectively. After marking out this entire chart, you draw out a horizontal line on the high and low of each session. Use a shallow line to avoid overcrowding and to get your entry opportunities. Now from here, we see that price rejected this session's high and dropped, giving a wick to the upside. This low here, price bounced on it and went up. Also here, price came to the line, gave an engulfing candlestick and continued up. This low here was rejected, price tapped into it, gave a wick to the downside and went all the way up. This also did a double top and dropped. Price keeps on bouncing on the previous session's high and low before beginning a major trend in the market. So having your chart marked out like this will give you edge in the market and open up entry opportunities. The next strategy is the Asian range strategy. The Asian range is characterized by consolidation with little to no volatility. To trade this strategy, you first mark out the open and close of the Asian session and the high and low of the session. The open in this case commences from 11 p.m. then ends at 7 a.m. Do this for the entire chart. This is how to do it. First, you mark out the opening from here and close at this point, which is from 11 p.m. to 7 a.m. This blue box covers both the high, low, open and also the close. Then towards London open, you wait for price to make the first false move before entry. Usually, if price was meant to go uptrend, it will take out the low of the Asian session. If it was meant to go downtrend, it will take out the high of the Asian session before dropping. Here, price took out this high, gave a double top, then drop. The reason this is because the highs and lows of the Asian range are where price and others are left. So price takes out all the others, then drop. Here again, price spiked down below this range and moved up. Your entry would have just been after this low is taken out. Another one here, a spike with a hammer, took out the low and price went up. Your entry just after this hammer formation and your stop loss below. Another example here from GJ. After your Asian range are boxed out, you wait for pre-London open. Price took out this Asian low, gave a wick to the low, then you ride just after it. Your stop loss below this wick. Another one here, price took out this box area to the low. The minute that happens, you know that price was going to go up, and so you enter right after this bullish engulfing candlestick and ride all the way up. Your stop loss just below this candlestick. This has to be done on the M15 time frame. A very quick recap of this strategy. Make sure you box out the entire Asian range. Start from the market close from the previous day to pre-London open at 7 a.m. Your time zone should be set at UTC and the whole analysis be done on M15 time frame. The head and shoulder strategy. The head and shoulder strategy is a trend reversal strategy that occurs when a bullish trend is in a process of reversal to downtrend. This shows a pattern of the head and shoulder. The shape is formed by price moving uptrend. The left shoulder, the swing high, is the head, and the right shoulder, which signifies a change in trend, forming lower high. The neckline, which also acts as support. The inverse head and shoulder, on the other hand, occurs when a trend is in the process of reversal to uptrend. This is the opposite of the head and shoulder pattern. Price moving downtrend, the left shoulder, swing low, which is the head, and the right shoulder, which signifies a change in trend, forming higher low. The neckline, which is the resistance level. There are two variations of this pattern. The first is a type that has the neckline broken before the formation of the right shoulder. It's also called breakup structure head and shoulder pattern. While the second type has the shoulder and the neckline all on the same level. This is the non-breakup structure head and shoulder pattern. It is good to know that the head and shoulder pattern shows that buyers are beginning to lose momentum and sellers are beginning to gain more ground, so price will start to reverse. While the inverse head and shoulder shows that a downtrend market is in a process of reversal as sellers are beginning to close out of their selling positions and buyers are coming in heavily. There are two ways to trade this pattern. First is by entering after the close of this neckline. Second is to wait at the retest of this neckline. To enter after the close, you wait for price to close at this neckline, then you place your sell immediately, your stop loss above the right shoulder, and you ride all the way down. Or you wait for price to retest this neckline, like here. You enter in and ride all the way down. To trade the inverse head and shoulder pattern, you wait for the pattern to be fully formed. After that, you buy at the close of this candlestick at the neckline and you ride all the way up. Stop loss placed at the low of this right shoulder. Head and shoulder pattern is a very reliable trend reversal pattern in the Forex market. Next strategy is a three-touch trend strategy. A trendline strategy is one of the reliable trading tools used by the big guys to trade the financial market. It has a very high win rate and easy to trade. Now, how to draw a reliable trend line? There are two ways to draw a valid trend line. First, draw from the wick to wick, and the other is from the wick to body. Let's look at the wick to wick. To draw the wick to wick, you place your trend line on the tip of the first wick and drag to the tip of the second wick and into the future. This is the wick to wick trend line. Wick to body. To draw this, you place your trend line from the tip of the wick of the first projection and drag into the body of the second projection and into the future. Example of wick to wick here. Point 1 here, which is the wick. Point 2 here, which is the wick, and dragged into the future. Example of wick to body. Wick 1, which is the first touch. The second touch here is on the body and dragged into the future. Of the two types, the second type is more reliable. The touches are prerequisite to confirm that your trend line is valid. Now, how to trade using the trend line strategy. Once you confirm your first and second touch, wait for the third touch, which is where the whole strategy lies. Once price makes contact with the trend line the third time, you get in for your trade and flow with the trend. One thing you should know is that your entry can either be on the trend line or a few pips away from the trend line as it makes contact with the line the third time. To get a valid entry point at the third touch, you look for a very valid point of interest at the area of the trend line. Here is an example. Price made the first touch here, then price continued up and made a second touch here, so you have your trend line drawn. It came back and touched the third time. Your entry at just the close of this bullish candlestick and your stop loss below. You ride all the way up. This is a good example of wick to wick trend line. An example here of wick to body. Price made the first touch here, which is the beginning of the trend. This second touch is a body contact, which made it wick to body. Price came back and made the third touch here. Your entry just after the close of this green candlestick, or you can go on a lower time frame to get a better sniper entry. Your stop loss just below this candlestick and you ride all the way up. See how price went up without hesitation. This three-touch trendline strategy is very valid and still very much in use by most profitable traders. The most preferred time frame for this strategy is a 1 hourly time frame, but can also work on any time frame. Adding other confluence to this strategy makes it even more reliable. The next strategy is the trap candlestick strategy. The Forex market can sometimes be tricky with its false move, which gets a lot of traders to take trades in the wrong direction. These false moves most times usually present like a candlestick, which get a lot of traders trapped in the wrong direction. But if you understand it well, you can take advantage of it. A classical example of this kind of candlestick will be the shooting star candlestick and the hammer trap candlestick. The shooting star is a candlestick pattern that is formed in an uptrend market and signals trend reversal when it occurs on a key level or on a resistance. This candlestick is a trend reversal signal and sometimes can act as an entry confirmation. The structure of the shooting star. In an uptrend market, price begins with a bullish candlestick showing a high buying pressure to the upside. Because of this push, most traders will get in with the hopes that it's a trend continuation. Then price will suddenly drop from the bullish and form a wick to the upside and a smaller body to the downside. The wick is where a lot of traders are trapped, and the small body to the downside points to the new direction of the market. There are two types of the shooting star candlestick based on the body of the shooting star. The bullish shooting star. In this type, the candlestick started as a bullish candlestick and throws a wick to the upside and closes with a smaller body down, but the smaller body is a green candlestick. This is the bullish shooting star. While in the bearish shooting star, price gave a wick to the upside and closed with a small body pointing downward. The small body is a bearish candlestick. Of the two types of shooting star, the bearish shooting star is more reliable because it indicates high selling pressure. Now, how to trade this strategy. The pattern is easy to trade. Here are the confirmations you'll be looking out for. First, the wick on the key level, and second, the length of the wick must be greater than the small body. Once you spot this candlestick on a resistance, you wait for it to close, then you place your trade after its formation, top loss above, and you flow down with it. Example here, price moving uptrend got to a key level, gave a shooting star candlestick, and you see how the candlestick nicely formed. This shows that traders are trapped in this move. You place your sell and your stop loss just above this wick and you flow with the new trend. Another example here, price got to a key level, your shooting star trap candlestick pattern here, you check to confirm the length, then you place your sell and flow with a new trend. You see how price drop. This simple candlestick pattern is very reliable. Now on the hammer, this is the inverse of the shooting star pattern. It's a candlestick pattern that occurs in a downtrend on a support key level. It's formed in a downtrend market, price trending downward. It began as a bearish candlestick, which made a lot of traders to see it as a trend continuation, then suddenly withdraw from the trend and gave a wick to the downside, trapping a lot of traders that got in for the sell, forming a small body to the upside. There are two variations of this pattern based on the small body. The first is the bearish hammer candlestick. In this type, the price forms a wick to the downside and a small body up. The small body is a bearish candlestick, while in the second type, the body is a bullish candlestick. Of the two types, the bullish type, which is the second type, is more reliable because it shows strong bullish pressure to the uptrend. Note, this is an uptrend pattern, an indication of a shift from bearish sentiment to a bullish sentiment. Now let's look at how to trade. The hammer candlestick is simple to trade, just like the shooting star. It acts as a trend reversal and also as an entry confirmation. The confirmation you look out for when trading this pattern are: 1. It must be on a key level. 2. The length of the entire wick must be at least 2 times the body. To trade, you enter for a buy after the formation of the hammer candlestick and place your stop loss just below. A good example here, price came to the support level, gave an hammer candlestick, you enter in here and your stop loss at the low and you ride all the way up. Next strategy is the supply and demand strategy. The supply and demand remain one of the oldest technical analysis strategy used by traders. They are fundamental concepts that drives price movement in the financial market, and by mastering it, you can improve the quality of your trade. Now, how to identify the supply and demand zone? First, let's start with the supply. Look for areas where price had reversed from, like an order block, box it out and drag into the future. While in a demand zone, you look for an area that shows strong price reversal to the upside and then box it out. Supply and demand strategy is very reliable because price will always want to retest an area of previous high points or low points, so you'll be trading in line in this area. Now, how to trade this strategy? Once you have your areas marked out, trading supply and demand becomes very easy. Let's start with the supply. In the supply zone, you will be expecting to sell because this will be forming an overall downtrend market. Wait for price to come back to the supply zone. Then the moment you have a tap into this area, you watch to see if price will reject it. Once you get a candlestick rejection, like the evening star, you place your trade and your stop loss above this zone. Like here, price first gave a rejection, which would have entered, but price came back again. So having your stop loss placed at the top, you'll keep your trade safe. Now, demand. To trade demand, you'll be looking to buy from the demand zone. So after boxing out your demand zone, wait for price to come back to the box, like here. Tap into it, then you wait to see your candlestick confirmation. A wick to the downside that shows rejection of the price, like here. Then you get in and ride all the way up. Stop loss just below this candlestick and you ride all the way up. Another example here, your demand zone boxed out, you wait for price to come in. Once this engulfing bullish candlestick closes, you buy immediately and ride all the way up. Your stop loss below this candlestick. This is how to trade your supply and demand strategy. Now, let's look at the break and retest strategy. The break and retest strategy occurs when price is in a process of reversal to a new trend. It's a very highly reversal strategy used to confirm a change in market sentiment. There are 3 variations of the break and retest strategy. The trendline break and retest. In this type, price broke through the trendline and come back to retest it. At the retest is where we place a trade. How to trade this type? Once you notice price broke through this trend line here, you wait for the pullback, then price came back to retest on the trend line. Your entry here and your stop loss above this candlestick. Another example here, price was trending downtrend, broke this trend line, you wait for a retest and buy it all the way up. The second type or the second variation is the structure break and retest. Here, for example, in an uptrend market, price was making higher highs and higher lows. Then price broke out of this low, which is the higher low point, and came back to retest it here. This signals a break of structure and a retest here to begin a new trend. How to trade this type? The moment you notice that price has closed below this higher low point, you patiently wait for price to come back and retest it here for you to go in. Your stop loss just above this high. The third type of break and retest is a support and resistance break on retest. Here, price broke through the support and came back and retested it. You place your trade right here and ride all the way down. Another strategy we'll look at is a three-step strategy. The three-step strategy is a trend reversal pattern that appears at the end of a trend at the key level. It's a threefold or rise structural move. Anatomy of the pattern. In an uptrend market, it gives a three-step rise. The first rise, the second rise, and the third rise, then a drop. While in a downtrend, as price approaches a key level, it gives a first step drop, second step drop, and the third step drop usually comes with a reversal to the upside. Note, these steps are the same as lower lows and lower highs, and higher lows. They are price rejection signals that occurs when price approaches strong rejection points. Now, let's look at how to trade this strategy. At the third step, price will begin to create a minor structure to the upside on a lower time frame. Once you spot this break of structure on the lower time frame, you enter in for your trade. The confirmation you'll be looking at for a candlestick rejection, an indication that traders are rejecting the current price. And the second confirmation is the minor break of structure on a lower time frame. Now, the next strategy we'll be looking at is the engulfing candlestick strategy. Candlesticks can act as a strong, reliable strategy for day trading. The engulfing candlestick is one of the most widely used patterns for entry. The bullish engulfing candlestick is a price reversal signal that occurs in a downtrend and signifies a potential shift from downtrend to uptrend, while the bearish engulfing candlestick occurs in an uptrend and signifies a shift from uptrend to downtrend markets. Now let's look at the anatomy of the candlestick pattern. The first candlestick is a bearish candlestick that shows a downtrend market. Then the bullish candlestick completely engulfs it, showing a shift in sentiment from bearish to bullish. While in a bearish engulfing, the first candlestick is a bullish candlestick. Then the second, which is the bearish engulfing candlestick, also showing a shift in sentiment from bullish to bearish. Now, how to trade this pattern? You have to confirm that the bullish engulfing pattern is fully formed by waiting for it to close. Enter in for a buy after the bullish completely engulfs the bearish candlestick and your stop loss below this bullish candlestick. Another example here, price came to a key level here. The bullish candlestick which completely engulfs the bearish, your entry after the close of this bullish engulfing, and your stop loss below this bullish candlestick. In an uptrend market, price gets to a key level. You wait for the bearish candlestick to completely engulf the bullish candlestick. Then you place your sell on the key level immediately and ride all the way down. Your stop loss just above this candlestick and price dropped immediately. The engulfing candlestick is mostly used as an entry confirmation in trades. Another strategy is the imbalance strategy. Imbalance is market inefficiency. It's area where the numbers of buyers and sellers do not correspond. Thus, either the buyers were greater than the sellers by very much margin, or the sellers were greater than the buyers by a very wide margin. Now let's look at what a balanced market looks like. In a balanced market, price makes contact on the chart through wicks. Example, candle A and candle C made contact through wicks. This shows that price is balanced in this pair at this point in time. While in an imbalanced market, there is significant gap between candle A and candle C. This gap is what we call imbalance. It's a result of too many buyers or sellers in the market driving price to one direction. Now, how to trade this pattern? Because this is a price inefficiency, after the move, the central bounce will take price back to fill the inefficiency, and so we will wait right there for price to come back to fill it, then take trade alongside with the market makers. Example here, at this imbalance, we place our sell limit. Price came back, fill it, and dropped immediately. Another example here, price came to this imbalance, fill it, and went up immediately. So your buy limit would have just been there at this point, and you ride all the way up. It's good to know that imbalance can also be used as an entry confirmation in trade after analysis. Learning to use them will be a great tool to your trading arsenal. Now, support and resistance strategy. It's basically taking trades at points where price failed to break through. Support acts as a floor where price bounced off many times and had hard time breaking through. Resistance, on the other hand, are like roof or ceiling where price failed to break through and so reverse from. To draw your support, look for areas where price find very hard to break below. Like here, you see how price bounced off this area many times. While to draw your resistance, the points above price where price bounced off many times, like here, then you draw your resistance. It's good to note that once price breaks through a support level, it automatically becomes a resistance. like here, price break through this support and use it as a resistance. While when price breaks through a resistance level, it turns to a support, like here, price broke through this resistance and it becomes your support. To trade this strategy, wait for price to come to this support level. Once it gives some signs of rejection, like here, then you enter in for your buy and your stop loss just below this candlestick. Another example here, price came to the support, couldn't break through it, you buy immediately and ride all the way up. While in a resistance, once price fails to break through it, you sell and place your stop loss just above. Like here, price rejected this resistance, your entry there after the close of this candlestick and your stop loss above. This strategy is easy. Remember, keep it simple. Now, the market structure strategy. Market structure is the foundation to understanding price action. It's the key to technical analysis. In an uptrend market, price comprises of higher highs and higher lows. Like on this chart, the break of structure in an uptrend market only happens when price broke through the previous higher low point. While in a downtrend, it comprises of lower lows and lower highs. The break of structure in a downtrend only occurs when price breaks through the previous lower high. In an uptrend market, the higher lows is always the pullback or retracement. These higher low points are where traders take trades, while in a downtrend, the lower high points are always a retracement. You sell at the lower high. These retracement levels can be measured with a tool called the Fibonacci retracement level. This tool measures the extent of the price retracement on the chart. There are different levels of retracement on the Fibonacci tools. We have the 38.20%, the 60.80%, the 88.60%, and the 100% retracement level. Anything more than the 100% retracement level is considered a break of structure. Let's look at how to use the Fibonacci tools. Place your tool from the beginning of the previous lower high in a downtrend market and drag to the lower low. Then the retracement the price made will be consistent with one of the Fibs level, like here, this is 61.80%. Then in an uptrend market, start from the higher low, drag to the higher high and measure the retracement level. This is on a 88.60%. Using Fibonacci tool can add more confidence to your trade. Now, let's look at how to trade this strategy. Once you use your Fibonacci tool and measure your level of retracement, wait to see if price will reject this level. Then place your trade, like here, price rejected this 61.80%. Your entry after this weak rejection and you float till the low is taken out. In an uptrend like here, you place your buy at the close of this candlestick at the 88.60% and ride all the way up. Using this Fibonacci tool can add more confidence to your trades. Now, the next price action strategy we'll look at is a double top and double bottom pattern. A double top is like M pattern that signals trend reversal and can generate consistent profit if traded correctly. A double bottom is like a W pattern that occurs in a downtrend market and signals a trend reversal to the upside. Now let's look at the anatomy. Price was going uptrend, then a pullback, which forms the first top and the second top here. The double top occurs only on an uptrend market, while in a downtrend, price was trending downward from the first low and the second low here, which completes the W pattern or double bottom. The neckline holds a strong structural significance, and the break of this neckline is what makes the pattern a valid trend reversal pattern because it signifies break of structure. The validity of this pattern lies on the break of the neckline. There are two types of the double top and double bottom pattern. In the first type, the right hand is higher than the left hand, characteristic M pattern, while in the second type, the right hand is slightly lower in an uptrend market, while in a downtrend is slightly higher than in the left bottom. This second type is more reliable. And let's look at how to trade it. All you have to do is wait for price to close below this neckline and then you place your trade. While in a downtrend, you wait to see a break of this neckline. A good example here. Now, mastering these price action strategies can give you an edge to your trading. See you in the next episode.